The Magnificent Seven has driven 50% of the S&P 500 gains so far this year. That's according to Yahoo Finance's calculation. Our next guest, who's actually one of the first on Wall Street to coin the term Magnificent Seven, well, he's warning that the group's remarkable run is over. So let's bring him in. Mike O'Rourke, JonesTrading Chief Market Strategist, is here. Mike, it's great to have you. So there's so much excitement surrounding the Magnificent Seven, obviously still being led by Nvidia, but the group as a whole. Why are you warning that maybe the best days are behind it?
Well, I think the key factor here is this earnings season that we've just had. The peak week for earnings season was the beginning of February 1st. And I think Apple reported that day. I believe Meta reported that day. And, we just had Nvidia kind of wrap up the Mag 7 names last week. And what we saw was the biggest market cap gain in one day was Meta when it reported, and then that was obviously shattered by Nvidia last week when it had 277 billion in market cap. And I think those prospects for those two names are so drastically different, and their valuations are more attractive than the rest of the group, that I think you're going to see investors differentiate between those leadership names and favor ones over the others. And you're not going to have this rising tide where these seven names lift the entire market higher, or the S&P 500 higher for that matter. And I think that's going to be the difference going forward. It's going to make for tougher returns.
If we did see a wave of profit taking among the Magnificent Seven and people holding on to that, investors holding on to that, what type of correction do you believe that would also trigger within some of the broader market?
Well, that's the interesting thing. As that group rallied sharply last year, the other 493 became less expensive. Mm-hmm. So that it would be nice to see rotation out into the balance of the market, and I'm not sure that they're the Magnificent Seven are going to create a market-wide correction. I just think like investors are looking at the market today and they're sitting there saying, okay, Meta had problems a couple of years ago. They seem to have sorted them out. It trades less than 25 times earnings, is growing quickly. Nvidia is obviously growing very quickly. Their revenues are supposed to grow 70% this year. And they're making the comparison to an Apple where revenues are supposed to grow 1.5% this year, or a Tesla where they're supposed to grow 15%, but we know the EV space is experiencing a lot of challenges. So I think you're going to see rotation within the group, and I think you're going to see people venture out into other places in the market. Obviously, one place they've already started looking is the GLP-1 diet drug names like Lilly and Novo, where Lilly is now bigger than Tesla in market cap. So I think that's what we're looking at here is more of a churn. I think it's going to prevent the market from having widespread gains, but I think people will be looking for different investment opportunities.
Mike, what do you think the upside then looks like for some of those GLP-1 names?
I'm not a drug analyst, but it's clear that they are disrupting numerous industries, right? Yeah. They're disrupting, obviously, the packaged foods industry. They're disrupting the medical device industry. So they're disrupting the healthcare industry, for like hospitals and managed care providers, if we're going to have healthier individuals or if people living a healthier lifestyle. So there is a lot of interesting aspects to that trade. I just don't, I don't look at the stock specifically, but I know that obviously they're performing very well.
Are there other winners, especially when you think about the broader theme that has propelled the Magnificent Seven? It's been around generative AI, and it's been on some of the large cash shorts that those companies as well, they sit on top of in order to deploy some of the most advanced or quickly deploy solutions into the market that allow them to capitalize on that generative AI trade. So what is the next part of the generative AI trade from your purview that could really catch hold?
Well, it's just really interesting. I think what we're seeing among these names is the digestion of the moves they've had, right? You're looking at a Microsoft that added $1 trillion of market capitalization after making its biggest investment in OpenAI early last year. But then you're hearing reports that the users of the early functionality are thinking it's overpriced or not worth the money they're paying for. Obviously, you have Google and its Gemini debacle last week that it's still licking its wounds on. So I think that's the next phase to see, okay, we know it's an important technology. We know it should be a game-changing technology, but there's obviously some kinks that need to be worked out. And in the meantime, we've added trillions of dollars in market cap. Again, it just makes more for the argument for consolidation in the space.
Mike, I'm curious from a strategy standpoint, how closely are you factoring in the Fed's timing of that first rate cut? And is too much being, I guess, discussed about the actual timing versus the number of cuts and the extent of those cuts between now and year end?
Well, it's interesting. Obviously, the market was very excited for rate cuts. From my perspective, where I see it, I don't know why, because we've had a very strong economy. We have an unemployment rate near 6-decade lows. We have inflation that's still running very hot. I know the 3-month, annualized inflation rate is closer to 2%. But again, we're still seeing a very hot economy. Obviously, GDP revised this morning down by 10 basis points to 3.2%. That followed a 4.9% GDP print, and this quarter's tracking 3.25%. So I don't think the rate cuts are appropriate, at this moment. And I think that's going to be an interesting story later in this year, because you had a lot of companies refinance debt during the pandemic at very low interest rates. As those maturities start to come due and they have to roll that debt with the Fed funds rate above 5%, it gets a little more challenging. But the market has been extremely optimistic on rates for the past several years. It didn't think the Fed was going to raise as high as they did. It thinks they're going to cut more so than they will. But right now, the policy is appropriate, and the Fed should be, pushing the pause button on market expectations about rate cuts, because they're just not warranted at this point in time.